How money really works, explained simply. Imagine you're holding a $20 bill right now. It's just paper, costs maybe 10 cents to print, has no gold backing it, can't be redeemed for anything physical. So why is it worth $20? Why does the cashier at Starbucks accept it? Why does your landlord want it for rent? The answer is way stranger than you think. And once you understand it, you'll never look at money the same way again. Here's what's wild. Almost everything you think you know about money is probably wrong. Money isn't backed by gold. Most of it doesn't even exist physically. And the way it's created is something 90% of people completely misunderstand. So let's break it down from scratch. No complicated economics, no boring textbooks, just the real story of what money actually is and why it works. What's up, everyone? Today we're answering the question almost nobody can explain correctly. How does money actually work? We'll break down what gives money value, how it's created, why governments can just print more, and what this all means for your wallet. By the end, you'll understand money better than most college graduates. Hit that like button if you're ready to see through the matrix. Let's start with a story that'll blow your mind. Meet Sarah. She's 25, just started teaching, and gets paid $4,000 a month. That money shows up in her bank account as numbers on a screen. She uses her debit card for everything: groceries, rent, Netflix. One day, Sarah realizes something weird. She's never actually seen her paycheck as physical cash. It's just numbers on her phone. Here's the crazy part. That $4,000 probably never existed as physical cash. Her school district didn't hand her bills. The bank didn't move actual money anywhere. They just changed some numbers in a computer, added $4,000 to Sarah's account, subtracted $4,000 from the district's account. That's it. That's money in 2025. Digital numbers that everyone agrees are worth something. But why do we agree? That's where it gets really interesting. This is lesson number 1. Most money doesn't physically exist. It's just trust stored in computers. Let's go back to the beginning because money used to be completely different. Thousands of years ago, money was simple. You had gold coins, silver coins, copper coins. The coin itself had value because the metal was valuable. You could melt down a gold coin and it was still worth something. That's called commodity money, money that has intrinsic value. This worked pretty well, but it had problems. Gold is heavy, hard to divide, difficult to carry. Try buying a coffee with a gold bar. How do you make change? So governments started printing paper money. But here's the key. Originally, that paper was just an IOU for gold. A $20 bill meant you can exchange this for $20 worth of gold at the bank. The paper itself was worthless, but it represented real gold sitting in a vault somewhere. This was called the gold standard, and most of the world used it until the 1970s. Your grandparents lived in a world where paper money was actually backed by gold. But then everything changed. In 1971, President Nixon made one of the most important economic decisions in history. He ended the gold standard. Suddenly, dollars weren't backed by gold anymore. They weren't backed by anything physical. And you know what happened? Nothing. The economy didn't collapse. Money kept working. Why? Because money doesn't actually need to be backed by gold. It just needs 3 things. Thing number 1. People need to trust it will be accepted tomorrow. If you believe that Starbucks will accept your $20 bill tomorrow, then that bill has value today. Money works because we all believe other people will accept it. Thing number 2. Government needs to declare it legal tender. This is huge. In the US, the government says dollars must be accepted for all debts, public and private. You can't refuse dollars for payment. That legal requirement creates forced acceptance, which creates value. Thing number 3, supply needs to be controlled. If anyone could print dollars, they'd be worthless, but only the Federal Reserve can create new dollars. Scarcity, even artificial scarcity, creates value. This is called fiat money. Fiat is Latin for let it be done. Basically, it means money by government decree. It has value because the government says it has value, and everyone trusts that system. This is lesson number 2. Money is worth something because we all collectively believe it's worth something. That's it. That's the secret. Now here's where it gets really wild. How is new money created? Most people think it works like this. The government prints money, then spends it or gives it to banks. But that's not how it works at all. Here's the real process, simplified. Step 1. The Federal Reserve, the central bank, creates new money, but they don't just print it and hand it out. They create it digitally by buying assets, usually government bonds. They essentially type new dollars into existence on a computer. Step 2. Those new dollars enter the banking system. Banks now have more reserves, which means they can lend more money. Step 3. Banks create even more money through loans. Here's the mind-blowing part. When a bank gives you a $10,000 loan, they don't take $10,000 out of a vault. They just add $10,000 to your account. They created that money out of nothing, backed by your promise to repay it. This is called fractional reserve banking. Banks only keep a fraction of deposits as reserves. The rest they lend out, creating new money in the process. Let me show you how insane this is with Sarah's example. Sarah deposits $1,000 in cash at her bank. The bank keeps $100 as reserves, 10%, and loans out $900 to someone else. That person deposits the $900 in their bank, which keeps $90 and loans out $810. That bank keeps $81 and loans out $729. Sarah's original $1,000 in physical cash has turned into over $2,700 in total money in the banking system. The banks created $1,700 of new money just by making loans. This is lesson number 3. Banks don't lend money that exists. They create new money every time they make a loan. Now you're probably thinking, wait, if they can just create money, why doesn't the government create infinite money and make everyone rich? Great question. Here's the problem. Inflation. Imagine you're at an auction. There's one iPhone being sold and there are 10 people bidding. Everyone has $500. The phone might sell for $400 to $500. Now imagine the auctioneer suddenly gives everyone $5,000. What happens? The bidding goes crazy. That phone probably sells for $4,000 or $5,000 now. The phone didn't get more valuable. The money just got less valuable because there's more of it chasing the same stuff. That's inflation in a nutshell. When there's more money but the same amount of goods and services, prices go up. Your money buys less. $1 today buys way less than $1 in 1970, not because products got better, but because there are way more dollars now. This is why governments can't just print unlimited money. Sure, they can technically do it, and some countries have. Zimbabwe did it in the 2000s. Venezuela did it in the 2010s. Their currencies became worthless. Hyperinflation destroyed their economies. The trick is balance. Create enough money to support economic growth, but not so much that it causes runaway inflation. Let's talk about what this means for normal people like you. Your savings are constantly losing value. Even with low inflation of 2 to 3% per year, money sitting in a regular savings account is getting weaker. That $10,000 you saved? In 10 years at 3% inflation, it'll only buy what $7,440 buys today. You didn't lose money, but your purchasing power shrank. Debt gets easier to repay over time. If you borrow $50,000 for college, inflation actually helps you. In 20 years, $50,000 won't feel like as much money because everything else costs more and hopefully you're earning more. The system benefits borrowers and punishes savers. This is by design. Fiat money encourages spending and investment rather than hoarding cash. It keeps the economy moving, but makes it harder to just save your way to wealth. You need to invest, not just save. Because of inflation, keeping all your money in cash is a guaranteed way to lose purchasing power. That's why people invest in stocks, real estate, businesses, things that can grow faster than inflation. This is lesson number 4. Understanding how money works changes how you should handle your money. Here's what most people miss about the modern money system. It's all based on debt. Almost all money in existence was created through loans. When those loans get repaid, that money disappears. The system needs constant new borrowing to keep money in circulation. It requires perpetual growth. The system only works if the economy keeps growing. More loans, more business, more production. If growth stops, the whole thing gets shaky. It's incredibly fragile and incredibly resilient. Fragile because it's based entirely on trust. If people lose faith in the currency, it can collapse fast. Resilient because trust in major currencies like the dollar is deeply embedded in global systems. Digital money is already here. Most money already exists only as digital records. Central bank digital currencies, CBDCs, are coming. Government-issued digital money that's even more trackable and controllable. The future of money might not involve cash at all. Crypto is trying to be an alternative. Bitcoin and other cryptocurrencies are attempts to create money that no government controls. Fixed supply instead of unlimited printing. Decentralized instead of centralized. Whether that succeeds or fails will define the next era of finance. So let's bring this all together. Money isn't backed by gold or anything physical. It's backed by trust, government authority, and shared belief. It's created through a combination of central banks creating base money and commercial banks multiplying it through loans. Its value comes from scarcity and legal requirement to accept it. The system sounds crazy when you explain it. Money created from nothing, value based purely on collective belief. It seems like it shouldn't work. But here's the thing. It does work. Not perfectly, not always. But it works well enough that billions of people use it every day without thinking about it. The real power isn't in understanding that your $20 bill is just paper. The real power is understanding the system behind it, how money is created, how it flows, why it has value, and how that affects your life. Because once you understand the game, you can play it better. You know why investing beats saving, why inflation is both a feature and a bug, why debt isn't always bad, why governments make the monetary decisions they do. That $20 bill you're holding, it's not just paper. It's a piece of one of humanity's greatest collective fictions and one of our most useful inventions. So there you have it. How money really works? From ancient gold coins to digital bank accounts. It's way weirder and way simpler than most people think. The whole system runs on trust, and as long as that trust holds, your money works. What surprised you most? Did you know banks create money when they lend? Drop your thoughts in the comments. I read every one. And if this changed how you see money, hit that subscribe button because we're breaking down every financial system that shapes your life. See you in the next one.